The earnings per share was up nicely. It appears that's because of buybacks. They actually have fewer shares outstanding.
That's right, and that is sort of the bigger story for Citigroup at the moment. Going to continue to be the story, I think, going into June when we'll get sort of the third leg of big buyback from them. But overall, as you said, fixed income a little bit better, equities a little bit worse. You know, they're very strong in the derivatives business. It was really a really strong quarter a year ago for Citi and all of their peers, especially in that business. So it could be partly about the comparisons. Fixed income a little bit better. That's sort of what we've seen across. But costs, and that's where we saw, I think, the positive at Goldman. I should note, however, Goldman, we don't know how much of the estimated costs might have included some estimate for litigation, which came in very small for that company. But cost cutting coming in, it looks like better than expected, and you know that's really what you'd hope for from the banks in a more difficult revenue environment.
What's interesting to me, Alison, and come on in here because we now have 4 of the major banks in the United States reporting, is this shift away from trading to deal making. And yes, we did see Deals Advisory provide a lift to all of the big banks. But my question is, how long can that last, number one? And number two, are they demonstrating enough of momentum in those other businesses away from trading to make this a sustainable kind of shift?
I think we're going to want to hear more about, you know, what these banks are seeing in trading. JP Morgan said that April looked a little bit more constructive on the trading front. Are we seeing the same from these banks? You know, the other issue, again, it's about the comparisons. Equity trading had a really strong, like, broad-based quarter a year ago. Fixed income strong also. Strong a year ago. The M&A business, we're seeing strength across the peers. As you point out, debt and equity underwriting, on the debt side of things, we do think that you know, we had a few great years there, but there's some headwinds seen by our credit strategist, Noel Hebert. So we do think that we have a little bit more of a bearish view on that front. And on the equity side of things, you know, we've heard about the shutdown in the first quarter. How much of that can get pushed into the second quarter?
Okay, Kathryn, let's bring you in here as an investor. How do you react to numbers, whether it's talking about the financial sector specifically or more generally? Does this tell us something about what's going on with the U.S. economy?
Well, sure it does, and I think it's really important to factor in Treasury rates and what the Fed is going to do going forward. Banks took a severe hit in this quarter, especially after we got the inversion at the front end of the yield curve and the expectation that the Fed would cut rates twice. My contention was, since we hit 236 on the U.S. Treasury, that banks would see a tactical move higher. And in fact, we did see a move higher from 235 to 250. I think that we get 10-year Treasury yields moving even higher through year end, which, given the correlation between 10-year Treasury yields and bank prices, means some potential move further to the upside in the banking sector if we get that move higher in Treasury yields.